Hi, everybody. This is Nathan Myers again, back with the Raises.com Top Capital Raiser Show. And today I'm joined by a very intelligent guest by the name of Jim Lee. And Jim Lee is an expert real estate syndicator. He got his bachelor's at UCLA back in 2010. And from then, he progressed in his career as an inside salesperson at LoopNet and CoStar. So Jim Lee managed to syndicate over 600 units as both a general partner and as a limited partner. And I'd like to introduce everyone to Jim Lee. And Jim, it's nice to have you here.
Thanks for having me on the show.
Yeah, no worries, no worries. And I really like the way that you masterfully explained real estate syndication for people that want to get into this. So maybe perhaps in your words, how did you transfer from W-2 to a full-time entrepreneur who's actually doing this for a living?
Absolutely. So, as a kid, I immigrated here from Taiwan at 11 years old. And I've always looked up to my dad that he brought us over here to give us the opportunity to thrive. And I feel like me looking up to him as a kid, I always wanted to be an entrepreneur. I just didn't have the confidence. And I think everyone goes at their own pace. And for me, I wanted to just go work in the real world, see what it's like, get some experience under my belt, and eventually transition to become an entrepreneur. So I did my W-2 job for about 7 years before I gained enough confidence to be able to start my own career as a real estate investor.
Well, was there any specific, for those who want to hit some of the numbers that you've hit, what was that one thing that made you confident enough to make that leap of faith?
I think it's just, again, it all comes down to your experience. For me, I had three W-2 jobs. All of them were inside sales because that's what I love doing. I don't like meeting people. I can just sit in the office, make dials all day. And so as I transitioned from one W-2 job to another W-2 job, I realized I couldn't just depend on my salary as a fixed income because I got laid off. Actually, to be upfront, I got laid off by all three jobs due to economic condition, due to buyouts by bigger corporation, and so forth. So after being laid off for the second time, that's when I started to invest back in 2015. I realized I got to create an additional stream of income just in case this happens again. And then for my third job, I was more intentional with what I was looking for. I was looking for startup company because I had worked for two big corporates. And so now it's just understanding how a startup works, how they build from the ground up. And once I gained all that experience, that's when I kind of just figured out, okay, I think I know enough to be able to start my own journey now.
It makes sense. And you've really gone far in the journey though, because there are many people that want to get into real estate syndications, to acquire assets and not to have to depending on a job that could foreclose somebody at a whim. So what would you say are the things people should know about real estate syndication? Like, what is a real estate syndication?
A real estate syndication is basically a partnership between investors who pool their resources into one single investment. This allows you to invest in multi-million-dollar deals like multifamily properties, commercial properties, or just to start a business, right? Movie productions, they need to syndicate. They need lots of capital to be able to hire actresses, and so forth, right? Syndication eliminates pretty much a lot of the risk by taking everything on your own while sharing the upside, right? It's the property generates an income that will be split amongst investors. It's a win-win situation. It's a bigger pie to split for everyone, where everyone can get a piece of it.
It makes a lot of sense. So we had a discussion a few days ago about the types of markets that you're involved in. So maybe perhaps share like the types of markets that you're involved in, what sector, what type of real estate do you usually syndicate?
The markets I focus on is Sunbelt states, any state that has sunshine, any state that's landlord friendly, um, where there's population growth, job growth, income growth, where you can see that down the road, 5 to 10 years, there's a huge potential growth, right? So right now, I syndicate two properties in Florida, and the reason why I like those markets, exactly what I just listed, all those, it checks off all the boxes. It's a very strong growth state. And what was your other question? Oh yeah, I focused mainly on multifamily value add buildings that's built in 1970s, which there's a lot of deferred maintenance. We can go in, add some value. It's kind of like flipping a property, but we're doing it on a bigger scale.
Yeah, two things. So, two of the things that you mentioned about landlord friendly, growing population, I find those points interesting, especially landlord friendliness. So, how can the average Joe look at landlord friendliness and use it to make sure that that the rules aren't hostile to a landlord or to somebody who wants to acquire real estate?
Yeah, so it's very important to find these states as landlord friendly because I live in California, um, Los Angeles, and this is a very tenant friendly state where I used to be a realtor. After I moved away from my W-2 job, the first thing I did was get a real estate license. And as a realtor, I work with primarily investors, and I've seen that in 2020 during lockdown, a lot of my investors couldn't get rents from their tenant because we have this tenant friendly law where it's eviction, something called eviction moratorium. I'm pretty sure you've probably heard of, where tenant can just stay there for 6 months to a year and not pay rent, and it caused a lot of headaches for investors. And I was able to witness that firsthand, and that's when I started to change up strategy because I started investing in California. My very first 2 bedroom 1 bathroom condo that I invested in 2015 is here. It's grown a lot, it's appreciated a lot, but since now that I'm syndicating, I gotta look out the best interest for my investor. I gotta mitigate as much risk as possible. So that's why we source deals out of state where it's more landlord friendly. And with landlord friendly state, just to answer your question, you're able to evict a tenant a lot faster than waiting 6 months to go to court with them. In landlord friendly states, you typically can get the tenants out with about a month, whereas in California it takes 6 months.
Wow. Yeah, it's a lot of cash flow that can add up. So, um, you mentioned the markets that you're in and the sectors. So, value add. So, perhaps for the beginners, explain value add, and maybe for the more advanced, walk through how that looks like.
Yeah, absolutely. So again, value add is just like flipping a home, where you take a beat up house, you go in and you fix up, do all the basic maintenance. So no different than if as we're doing multifamily, where when you when there's a change of ownership, typically there's the tenants will move out. There's bad debt that's not tenant not paying. There's you know empty rooms that you can start to renovate apartments, and so you have to take advantage of that when your occupancy goes from 90 to 80%, right? And so what we do is we typically go in, we renovate these units, right? Countertops, change the flooring. If it has carpets, we change into wood flooring. We add more amenities and some stuff like maybe a laundry inside the unit. And for those that have laundry inside the unit, we'll be able to charge more. We also add amenities outside, which of the unit exterior, which is like pet washing station, car washing station, storage space. Adding all these amenities allows you to increase your bottom line, which is your net operating income. You can charge more, right? And ultimately, the way how we add value and be able to charge more, because the commercial real estate, the price is dictated by the income it produces. So the higher you're able to increase your net operating income, the higher the price you're able to sell down the road. So one when we took over the project, so for example, this deal that we have in Orlando, 200 units, when we took over, the average rent per unit rents about $850 per unit. We bumped it up to $1,000 per unit without any renovation, and then the renovated units are renting for 1350. So that's about 55% increase. So that's how we add value.
Wow. And so I got two things from you so far when it comes to managing the actual investment. Because on one hand, there's risk mitigation of choosing the sectors that are growing, that are landlord friendly and all that. And then there's another side of it where you're reducing expenses so that the net operating income can stay high. So what are some of the, I guess, what's more important than being a successful syndicator here? And what would you say led to you actually, becoming a GP, becoming an LP, and choosing good deals? What makes a successful syndicator?
I think what makes a successful syndicator is having great partnerships. That's gonna take you a very long way because sure you can do everything by yourself, which is to raise capital, to find the deal, right? To manage the deal, and then to add value, asset manage the deal, and then to sell the deal. So you can do everything on your own, but chances are if you're doing some bigger deals like 100 plus units, it all depends on your partnerships. Like the deal that we have a total of 6 general partners, and so everyone's role is different. My role is to mainly raise capital, investor relation, and marketing, whereas my business partner, he works more on the operation side, the asset management part. So everyone has something to bring to the table. And again, this goes back to what I said earlier. That's the beauty of syndication, right? Everybody has something to give to this project. And at the end of the day, once we sell the property, everyone gets a piece of the pie. And that's why it's such a um, unique opportunity that I feel like everyone should be aware and should be educated on because they don't sell this type of they don't sell syndication in Wall Street.
A great partnership. When you mentioned a great partnership, I'm thinking about, at first I was thinking about on the investor side, but it looks like mainly one part that you're talking about is actually on the GP side. Making sure that you have good GPs that you can trust and you can delegate things to. Does this also apply to the investor side as well, or is it only when you say good partnerships, it's mainly about the GP side and making sure they have good advisors and a general partnership team?
Oh yeah, absolutely. So all our investors are also our partners too. Without their capital, we wouldn't be able to syndicate this property, right? So definitely investors play a big role in what we do because there are chances there, it's not just sometimes, I just want to be upfront with your audience. Sometimes, everyone talks about the good stuff, but they don't really talk about the bad stuff. The good stuff is okay, yeah, you invest and 5 years down the road will 2x your money back and plus the 8% passive income you get every year. Now, that sounds all good if everything goes well, right? If there's no economic downturn, if there's no hurricane that's hitting your apartments, there's if you haven't encountered problems in real estate, you haven't been in it long enough, so to speak. So I would say that when you talk about these investors down the road during, like, let's say for economic downturn like this, this past year, it's been rough on a lot of syndicator because of how fast the Fed had raised the rates,
Oh
and
yeah.
that kind of put a lot of these bridge loan under the water. And variable interest rate has rise like nearly double, and so nobody can foresee that. And so this is where our silent partners, not silent partners, but our investor partners would have to come in and help us inject more new capital into the deal to keep the deal sustainable to when the market shifts, so that we'll be in a better place.
Now the outlook seems a tiny bit better in the states, but yeah, it was the craziest hike I think in I don't know if it's all time, but one of the biggest, at least the biggest, the first time in 26 or 27 years that we were back at this rate. So, um, based on that, like, what would you say is happening in the world of syndications right now? So after we had this huge hike, what is the outlook you're seeing?
So the outlook is that, yeah, sure, there's, whoever's on bridge loan, variable interest rate would suffer and would probably have to have a capital call, just, inject new capital into the deal to cash in refi
Hmm.
into a fixed rate loan, which is more stabilized. So those deals will be, those people will encounter that issue. Now it depends on the relationship you have with your investor, right? The investor can say, no, we don't want to put more money into this deal. We don't want to throw good money at bad deal. And in reality, you just have to look at the bottom line. Have the GP team been doing what they're supposed to do and increase the bottom line, which is net operating income? Does this property have the potential to sell for 2x of my money back in a year or 2 years, right? So those are the things you have to look at. So that being said, there are going to be opportunities this year, because I'm beginning to see in the market that a lot of these syndicators, not a lot, I would say a few, have come across deals that's about 20 to 30% off.
Hmm.
And these are the deals where I suppose the syndicators couldn't get the capital call from their investors, and they just have to let the property go. And um and then and then basically another syndicator would take over the project. But right now, even if people need a capital call and they're not getting the capital, they're trying to delay that for as long as possible and trying to work with lenders on that. So it's going to be interesting this year, whether or not we're going to see more and more deals pop up, or if people are going to be able to hold on to their deal.
Capital call, you're just calling on the capital that an investor has committed. Because somebody can make a commitment doesn't mean that the money's in the bank account. So it's just calling on the committed capital, and then the refi is just refinance, out of the terms of a loan that they may have, and maybe they want to get better terms to deal with the high inflation rates. So I'm just trying to make it really simple for, I guess, some of the masses there that that are looking up to you.
Sure. I mean, I can give them an example just to clarify.
Yeah,
Let's
please.
just say if you put in $100,000 investment, right,
Mm.
2 years ago, and now your deal is going through a capital call. Typically, it's a capital call depends on how much you put in, but it's a percentage. Typically, like the general partners will ask 15 to 25%, depending on how much money they need for a capital call. So if you have 100,000 initial capital in the investment, so what 15 to 20% means, you have to pay 15 to 25,000 uh, to inject that new capital into the deal again to make the deal survive till 2025. That's basically, I mean, not survive, but to use that money to be able to cash in refi into a fixed rate loan, which is more
You can
stable.
just edit this part out.
Oh,
I appreciate
exactly.
that.
Cool. Yeah, no worries. So okay, you're so okay. So then, okay, so you explained it using that example, and that makes a lot of sense. One thing that you spoke about is what's happening in the market.
Oh yeah, absolutely. Now we all want interest rate to go down, but with the election, who knows? Who knows if the interest rate is going to stay stagnant or is going to continue to go up? But one thing I can tell you is that bonus depreciation might potentially come back, and that's a big thing for investors. For those that don't understand, bonus depreciation is basically where when you buy the property first year and you use all the expense, like basically to add value, you constructions and all that expense can be write off 100% tax write off. So, and that's why it's such it's such a great deal for high net worth earners to invest in syndication is because they get a big tax write off.
Mm.
And bonus depreciation was has been gone down has gone down ever since Trump got off. He It went from 100 to 80 to 60%. It was about to hit 40% this coming year, but they're saying it might increase back to 100%. It's still in the they're still voting for that.
Ah, yeah, that's a huge thing to keep in mind of. And then just going through all the, going through all the different, just different pieces that you mentioned along the call so far. Like you have a lot of the experiential knowledge here because I'm just hearing about all the examples you're giving. So before you got to this point, what are some growing pains that you had to go through, or I guess like your timeline of from Jim Lee 2024, and then Jim Lee, in the mid 2010s. What are some key points along your career, key growing pains that you had to go through and learn to get to where you are now?
Yeah, absolutely. So I think mindset is definitely the number one thing. I know it's, I know it's kind of, it's one of those things that everyone talks about, but it truly is something that you have to really get better at. Like you got to shift your mindset, right? Because I grew up in Taiwan, and my parents always taught me to save every dime I make, because in Asian culture, debt is slavery and cash is freedom to us. That's how we see things. And so I never borrow money, and I bought my first condo all cash, short sale. It's a small deal, but still, like I didn't understand that using debt is the ultimate leverage you can ever get, because you get tax write-off, you amplify your returns, you can split into, four different investments instead of putting all cash on one property where you hold all the liability, right? That's another issue. So I didn't understand all this when I first bought my property, and I read Rich Dad Poor Dad, the Purple Bible, and that's when I educated myself and kind of was able to shift my mindset. And also, who you hang out with is super important. Like your circle of influence, your circle, even your circle of friends. That's ultimately what's gonna take you to where you want to be. And so just be cautious about who you hang out with. I think like I like to hang out with smart people. In fact, my circle of influence are all people smarter than me,
Good.
and my team members, my friends, and all that. And so I think it's very helpful along this journey that you continue to see things in a different way, different perspective, different angle. Because when people disagree with you, you kind of just have to think, okay, why is that? Why is this opposing view coming? You got to look at different angles, and that's how you learn the most, right? If you're always stuck in the same mindset of, oh, I believe my belief is always right, I'm always, I know what I'm doing, you're not going to learn, you're not going to grow. That's just the reality of it.
Hmm.
So I think that's the number one key is mindset. And then everything from there, you kind of just apply that mindset to everything that you do, to every parts of your life, whether it's exercise, whether it's building your career, whether it's in relationship building, it all is going to work for you at the end of the day. So I think, you know the mindset piece, you basically, it's an ongoing thing. I'm still doing it. Like you still see very successful people in their 40s, 50s, 60s still working on it. Why is that? Well, it's because it's not it's a never ending growth that you always have to continue to remind yourself, because our subconscious mind takes over 95%. Once you pass the age 30, it takes over 95% of your head. And basically you kind of your brain is wired to do a certain thing because of what you've been through, the environments and your beliefs and so forth. So you got to be able to train that, and just look at the world in a bigger. I that's just how I approach it.
No,
um I don't know if that makes any
no, fair.
sense. I don't know if that makes any sense.
Well, hopefully it makes sense to the audience because I totally agree. I had a business mentor that, what's funny is that he taught a lot of technical things, but the most powerful thing about what he taught was the mind, and just how to see the world, how to have a worldview, and then how to see what you can do, and how to understand how to understand what's possible, what's not possible. So no, I totally agree, and I think more people should lean into that. People in general, in business in general. We're coming up on at the time of this recording, the end of I think it's Black History Month. So I think a lot of the African Americans that watch this should remember that too. I definitely think there's a lot of problems with people's mindsets, and that's why they cannot close deals. So I completely agree, and I hope people take this to heart, especially who you hang out with and everything. So how did you fix your mindset?
Education, networking, hanging out with the right people, getting in the right room, and again, just surround yourself with people smarter than you. I think that's the biggest component, is just education, networking, and then and then with time comes with experience, and with experience you're gonna eventually figure out what works and what doesn't work, right, for you. And so I think that all that plays a huge role in changing my mindset. And yeah, so I think that's primarily what I focus on. Is that and another big tip is always have mentors, right? I have probably like four mentors. The first two mentors I had like 10 years ago, but now as I continue to grow and um, progress, now I have different mentors. So it's going to change. We live in a ever fast changing world, and so life changes all the time. Everything begins, everything ends at some point, and so you just have to continue to progress. And because that, to me, that's the ultimate happiness.
I totally agree. And your mentors, are they people that are that are really close to you, that they're actively working with you, or are they more far away and more kind of like a coach that's remote, or is it like from somebody, an author in a book? I'm just curious on the type of mentor.
So my first mentor, um, when I got my real estate license, it was actually from her that she encouraged me to get my license so that I can help her with Chinese clients because I speak Chinese. And so that's how I kind of got into become a realtor, decided to make real estate as my career. So she taught me everything about real estate. And I met her through LoopNet, which is like 10 years ago. Because I used to be one of the I was number one sales in my office, number two globally for LoopNet. So a lot of people looked up to me. Even to this point, people are still contacting me because of that. And so she kind of, her and I, we were in touch. And then through her network, I was able to meet someone who's like filthy rich, and he is an ongoing mentor for me. He's basically helping me with all the business aspect of build how to build it from the ground up, because he owns an Amazon store, very successful. He sold his share for about 10 million or something the last year. So again, it's just your circle of influence, right? You got to surround with people with who's done it, who practices what they preach, right? And so in these mentors, I just come across through again, just through experience, through my previous jobs, through their network and so forth. And then my third one is basically just I in 2020 I pivot from being a realtor to syndication. I was educating myself about it, and
Yeah.
I knew I had a lot of pieces of the puzzle that's missing. So then I went out to network with a group of syndicators, and that's how I met my third mentor, who ultimately is my business partner. I call him my mentor because he also, the reason why I needed him as a partner is because I need to leverage his track record, his experience, and he's willing to teach me everything that I needed to know. So
Nice, and that makes a lot of sense. So, okay, looking at some of the deals, and because you've done over 600 I guess 600 units, what are the example terms of a deal? Because when we first met, we had a conversation about the terms of a deal. And you explained the different ways to safeguard people in an example deal that I found very interesting. So perhaps maybe if you could walk us through an example of a deal and how you would structure it to safeguard potential investors.
Yeah. So the typical deal that you see in multifamily value add is pretty straightforward. 8% preferred return. Anything that's above that's is 70-30 split, 2x equity multiple. And when you meet a bunch of syndicator, you're going to also realize if you had to if you have to put a bet on the horse or the jockey, which one would you bet? Well, the obvious answer is you got to bet on the jockey, right? Because no matter, basically a good syndicator can, take a bad deal and make it a good deal, and a bad syndicator can make a good deal into a bad deal. So you have to really ultimately your risk solely depends on the syndicator, right? Because you don't, as a limited partner investor, you don't have any saying in what the syndicator decides to do with the business, with the operation, and so forth. So what you can do to mitigate the risk is definitely get to know the syndicator, very very well, network with them, see how serious they take their business. If number one thing is that a lot of these syndicators out there right now is they don't do this full time. They're doing this as side hustle. I would not recommend investing in syndicators like that. No, I'm not saying that there aren't successful ones out there, but I'm just saying these are like the risk mitigation that you can do when as you're doing your due diligence. And so and then obviously the markets that they choose, it kind of has to it's got to align with your interests, right? Whatever you feel comfortable, whatever you think has the growth potential after doing your own due diligence, you kind of have to find the syndicator that aligns with your interests. You can sure, everybody can just throw a number at you. You can't just trust all that because that's all just projection, right? It doesn't always go that exact according to what they tell you. They're going that what they promise you that they're going to give you as your return on investment. So those are the couple of key points. The biggest thing I can think of on top of my head. There's probably like a long list of this, but those are the most important ones.
Nice. And risk mitigation is so critical, especially especially in this market. So, do you think that we touched on this before? Do you think that because of interest rates, there's a change in how you structure the deals, or because I know you mentioned that there's a lot of refinance happening. So, are the interest rates changing the typical terms of your deals?
Yeah, for sure. So there would be okay. So right now, the reason why we're not seeing as many opportunities is because sellers price expectation still hasn't come down for some reason, and then buyers just cannot afford buying these properties at such a high interest rate. It wouldn't make the deal work. It just numbers wouldn't pencil out. So right now what you're seeing is a lot of these syndicators, if they do end up buying a deal, they buy a deal that already has long assumption. And for those that don't know what that means, is just the deal already has a fixed rate loan intact. And so what the syndicator would do is buy that deal with the fixed rate loan already intact. So they're gonna just take over the project along with the interest rate. So that's what's happening. If you can find deals that's out there, it's very hard to just buy a deal with using bridge loan at this point. Variable interest rate. Everybody tries to use fixed rate, and even fixed rate is high. So that's why it's very difficult to get the deal to pencil out.
Mm. So at the beginning, when we had that first discussion, I like the way it's funny because just for on our raises.com side, we have recommendations on typical terms of a deal, and they seem pretty similar. So okay, so two times return on equity. You do 70-30 split after 8% preferred return. So I'm just going to quickly, just for the audience, and feel free to elaborate. But preferred return, the way I viewed it, is just a way to protect investors to make sure that if the return is lower than the preferred return, so if the return is lower than 8, then the GP, the way I understand it, the GP won't get their splits, or they'll get a different type of split, but they wouldn't generally get their split. And then the two times return on equity, if it's a 5-year term, I believe we're just saying that within a 5-year period, then the money is being doubled. So perhaps you can walk through, your definitions just for the masses on, pref, term, return on equity.
Sure. So pretty straightforward. I'm pretty sure if you started studying syndication, you've probably heard of the waterfall structure. What the waterfall structure means, once we make money, once we cash out refi, once we sell the property, who gets paid first? So the one that sits at the very top is the bank, right? Because the bank loans, majority of the money, the capital, to be able to for you to buy the property, right? Typically, 60 to 70%, depending on right now it's probably 50% because of the market. But they're still the biggest, the one that contributes the most capital. So obviously they get the money first. And then the second person in line that gets paid is typically your second loan, if you have one. So deals that have private equity groups, typically they just want they invest more on the debt side, so they don't get any equity. They just it's kind of like a hard money loan basically. They just get like 9%, 12% a year, 9 to 12%. And then follow after that is where you have the preferred returns, like you mentioned, right? So the preferred return pretty much are the first person and first investors, the first people in line besides the banks. And basically how preferred return works is that let's just say we take over a project and the first year we pay you at 1%. What preferred return means, the word preferred means that, whatever we don't pay you that first year, let's say we tell you you're going to get 8% preferred return, that 7% does get accumulated to the following year. So the following year will owe you 15%. And then if we don't pay you the second year, 8 plus 15, then you'll get 23% owed to you. And once we cash out refi, you're the first person to get that 23%. And once we sell the property, you're the first person to get that after we pay off the banks, right?
Yeah.
And then after that, that's when, the GP gets their 70-30 split. So anything above 8%, it's 70-30. 70% goes to the investors and 30% goes to us as general partners. So it's structured that way because it gives us the incentive to work hard on the deal. Because ultimately we want to reach to the very bottom, right? We want to be able to get our 30% share. But, most syndicators also invest alongside with their investors. So they have their own money in the game as well. So not only are they GP, they're also LP in the deal. So, but that's just to show the investors that we have some skin in the game, that we're not just selling the dream. That our money is in there. We're gonna work hard. We're all gonna make money together. That's again, that's the beauty of syndication.
Nice. No, exactly. And sometimes the wires get crossed because with the private equity funds and some different structures, like that carryover is a nice way that syndications work. But sometimes a lot of the funds, more in the sense of people that are establishing private equity funds, sometimes I don't hear that carryover. But no, that's an amazing example. So that being said, what are some good investors, or I guess some types of investors, or examples of people that invest that would be a good fit for your syndications?
Any high net Any high net worth earners, to be honest. I mean, like if you're talking about, doctors, lawyers, engineers, anyone who is in the medical field, nurses, those are my typical investors. But then you got the newcomers too, right? The new capital people, which are, people like e-commerce, Bitcoin, cryptocurrency, NFTs, affiliated marketing. These are people that, they're making good money out there, and they got money to be able to put away and invest in deals like syndication or stock market or whatever they decide to choose to invest, because we know how those professions can be volatile, right? Especially in Bitcoin. So for me, it's like it's all about education. It's all about educating everyone. Hey, you just understand there's volatility in what you do, so put away just a little bit, just consider that as your savings, and invest in syndication and see what it can help you, how it can help you build wealth and diversify your
Some
portfolio.
points that I want to cover because this is a really critical point. So, you had a lot of conversations because your background was more in sales, and then you do a lot of investor relations, and you had a lot of people that are really happy with you, through working with you. So, what are some of the things that people look for? So, like, are they looking for capital preservation? Are they looking for, cash? Like, are they looking for just that income, something that's producing a consistent yield? What are some of the things that they're looking for when they invest
No,
with you?
everything you just mentioned. Everyone's different, right? Everyone's journey is different at different stage and so forth. If you're talking about, let's say, boomers, for example, it's all about preserving wealth, right? They don't need to take too much of a risk. They don't need to invest in syndication that's value add. They look for apartments like Class A apartments, new construction, everything's already rent out, cash flows the first day you get into the deal. It's very stable. They like that. It's, backed by a hard asset. They don't want to be messing with the stock market anymore. So everyone's different, right? In my situation, why we target value is because I just started, right? We have to be a little bit more aggressive to be able to obtain capital to releverage that capital down the road, right? To continue to syndicate more deals. So everyone is different. But I would say majority of the people, the number one thing is they're looking for a tax write-off, right? It's a
Hmm.
shield, it's a tax write-off against their business. Oh, that's another thing. Business owners, I forgot to mention earlier.
Oh.
That's a big thing. Yeah, that's a big group of people that invest in syndication. If you own a business, chances are you probably will be looking into syndication at some point in your life. So, um, yeah, so tax write-off is the number one. And then the number two is financial freedom. We all know that rich people, they're rich because they work a lot, majority of them, I would say. And so what they're trying to do is, now it's not about having enough money. Now it's about getting their time back, getting their freedom back, getting all that, getting the ability to be able to spend time with their family, with doing whatever they want to do, pursue their passion and so forth. And that's the goal that they want to do. They're trying to get to, and to build that nice real estate, or it doesn't matter, a nice investment portfolio, to be able to have that financial freedom to choose what they want to do.
Hmm. No, awesome. And yeah, definitely people are going to be looking for some write offs, and that's a good point. So, I think we've covered quite a lot, and we've covered how to safeguard people. We've gone through your background, gone through growing pains, your journey. I guess, as we started winding down, just a few more things that I'd like to cover because um, people that want to actually people that are on the other side that want to be like you and syndicate. Um, how do you build trust with investors, and how have you managed to do that?
That's a great question. I'm still trying to figure out, because this starting off is tough. But what I can tell you is through a bunch of networking education, and for people who's done it for 10 plus years, they said that you just have to. be authentic, be yourself, because you can't be someone that you're not. Put yourself and try to put yourself out there and create an image and brand that's not you. You got to be yourself and basically just put yourself out there, and all over internet, whether it's create a podcast shows, that way you can, build your authority and in the space, so that people know that, okay, I can trust Jim. I know Jim. I've seen Jim many times on over and over. I listen to his podcast. I hear him. I understand his thought process and so forth. That's probably the quickest way, I would say, to build trust. Well, you got to go through the pyramid, right? The bottom layer is know, and then like, trust, and then eventually invest in you. So if people don't know you, they're not going to invest in you, right? The first thing is you got to put yourself out there, which is through all the social, well, which is unique. It's kind of like there's pros and cons, right? The pros is like nowadays it's super easy, right? You and I were doing a podcast show. You can go on YouTube. You can host a webinars, anything. You can just do anything. Write a blog on internet, and people will find you, right? And then once they find you, then like again, it goes back to being authentic and just be yourself, and eventually they'll get to know you, like you, and trust you, and eventually just move up the ladder that way. And the reason why I say it's still ongoing, I'm still figuring this out, because I'm still in that phase where I'm getting people to know me, but right now I'm trying to transition to figure out how to get them to like me faster and trust me faster, right? And so that's the only thing I can share. That's the quickest way. The quickest way, I would say.
Yeah, no, fair enough. And then, I mean, hey, there are investment banks that, raise upwards of 30 billion that are still trying to figure it out too. So, no, it's definitely, definitely something that everybody's working on, especially in this most skeptical, distrusting market that we've ever had. So, you find a good deal. How do you underwrite it, and how do you make sure it fits the types of the demands of the investors and your standards?
I think what you gotta just look at is cap rates, right? That's the one thing that as multifamily or any commercial real estate investors will tell you is what cap rate you're buying into, and then what is your plan? What is your strategy um behind when you're going to sell it? Because ultimately you got to be able to sell the spread, right? If your cap rate and the interest rate spread is the bigger it is, the better, right? The more margin you have. But when they get too close to each other, then your margins are squeezed. So you got to look at a deal, and you got to be able to tell yourself, okay, if I add value for this property in the first 2 years and so forth, by the time I sell it, whether it's cash out refi or sell it in year 3, 4, or 5, is that a good time? Will cap rate compress? Because ultimately that's what you're looking for, right?
Yeah,
To make that big margin.
yeah, and so getting that gap is critical. So cool, and and maybe even just before we start to slow down, maybe for the noobs and in the masses, so everybody understands what exactly is a cap rate.
Cap rate is just the way how your return on investment. So let's say, for example, right, if you are looking for, it's basically, if you want to look at more nerdy on the side, the nerdy side, which is just it's a net operating income by the asset value, right? Divided by the asset value, and it's basically it's a valuation where you can measure and compare different real estate investment depending on how long this property is it's going to take to return all the investment back to you with a and this is we're talking about strictly cash only, right? We're not talking about, this does not include interest and all that. So for example, if you put down $1 million and this property has a cap rate of 10%, it's going to take you basically 10 years to get your $1 million back.
And Okay, so we got that. And then back when you were talking about deal structure, you mentioned two times return on equity. How long do your deals, what is the term of your deal? So if somebody invests, when are they getting their money back? Is it like usually 2 years, 5 years, et cetera? Or
It just depends. It depends on the market condition. I'll give you an example. Like the deal that I had, my first deal in Orlando, we have renovated 90% of the units out of 200 units. So that's 180 units out of 200 in 2 years. And so if the market is great right now, we can sell it, but the market is horrible. So due to interest rate. And so it just depends. If we if the market was good this year or next year, we can definitely sell it. But right now we're shooting for sometime next year when the interest rate starts to go down, or in 2026. That would be the latest. So it depends. We project 5 years, but it could take anywhere between 3 to 7 years, and that's what I'm seeing in the space. Unicorn deals, 3 years, I would say 2 to 3 years. I've seen like deals that people bought in 2019, sold it in 2020 with 1.7 equity multiple.
oh,
That's insane in one
yeah.
year. Yeah.
It's like five
Yeah.
times.
So but that's a unicorn deal, right? It's like those don't come by every day, and that only happens during a good market. When the government just print trillions of dollars when everybody feels rich. So like it really depends. Yeah, so that's why we project 5 years. We like to stay conservative, under promise and over deliver.
Makes sense. Okay, beautiful. Okay, so to the audience, like let's say whether you're a syndicator, you're an investor, you're listening to Jim and you want to work with him, what would be the next step? So how can somebody, they're listening to this and maybe they want to even just ask you for some advice as an investor or as a syndicator, how do they get in touch?
Yeah. They can check out my website, formosainvesting.com. And I'm all over social media, Instagram, Facebook, LinkedIn, Twitter at Formosa Investing.
Okay, and then just how do we spell that? Just so that everybody goes to it and floods your website.
Formosa is spelled Formosa, and then the word investing, investing.com.
Nice. For Musa investing, and we'll make sure to put that in the links in the description. So okay. So then, as we wrap up, and I guess the last question I'll leave for you is, what is something that you want everybody to know? So Jim Lee, what do you want people to remember you for, both in this podcast and as they interact with you in general, and what do you want to be known for?
Well, that's a question I've never even heard of before, but that's good. I'm gonna write this down and make sure I have the answer next time. But what do I want to be known for? Well, I guess what comes up on top of my head is I want to be known for as a giver. I believe in giving um, back to everyone who's given me so much, especially my mentors, my peers, my friends, my circle of influence. It, Without them, there wouldn't be me today. So if I ever become super filthy rich, my number one goal is to be able to give back to the world, change this world, and make this world a better place for everybody to live. There's so many problems out there. Whether you're talking about child trafficking or abuse, domestic abuse, or environment. There's like so many things that we can work on as human being, and I feel like that's something that I want to be able to do as a giver, to give back. And because doing all this, I do it like I mentioned in the beginning of this podcast, is for the progress, to be able to stay happy, right? But it's not necessary for the money. The money is great, it's gonna help you in bad times, but I think like when I give, the more I give, the more I have, and that's what I find in life. So that's one thing I can say for now. I know it's probably not a good answer.
No, I mean, it's pretty good to get you off guard. So, yeah, give and you will receive. And it's like for every action, there's an equal and opposite reaction. So, this has been Jim, everyone, Jim Lee, and that's formosainvesting.com. Make sure you go to his websites, and the links will be in the description. If you want to learn about his, what he's working on, if you're a potential LP or you're somebody else interested. Jim, thank you so much, and it was awesome having you. I love this podcast.
Thank you.
Awesome.
I enjoyed it as well.
Awesome. Nice.